This time we are going to do the peer competitions. When we are doing the fundamental analysis of a stock, it is always better to see the same values of its peer. Then only we can come to with some conclusions, and we can also have more insights. The the competitors for ACC are Sri Cements, Ultratech Cement, JK Cements, and Birla Corporations, Ambuja Cements, and Nuvoco Vistas. So these are all the competitors for the ACC cement. We are going to analyze the various parameters of these competitors also with the ACC. Welcome to my video. Here we are going to do the peer competitors. And when we are comparing this is the current marketing price. So then the current marketing prices are varying like this for its competitor and ACC. The next one is the dividend yield. The dividend yield is good for ACC when compared with its competitors. This is we also saw when we are doing the comparison and details analysis in previous videos. So ACC has got a great dividend yield with a consistency, and this is for net profit quarter. The ACC's net profit is poor in the last quarter. It is in the negative value. The net profit is at the same time Ultratech has got really a good net profit. When we are comparing the sales also the Ultratech has got a great number and the ACC has got somewhat in between. Then this is the profit variance. The variance is the difference between the budgeted value and the actual value. The actual value and the budgeted value. We know that every company has come with some kind of budget based on the current economic level, their future applications, growth, and the historical data. They come with some kind of budget value and the anticipated value. If the variance is in positive and a great value, then that would be better for the company. However, all in the ACC and all these competitors have got minus values for this variance. Especially ACC has got minus 115.79 value. So all these companies have not reached their budgeted value in the last quarter. So this is what we can infer from this one. So not only ACC, all the companies of the competitors of ACC having got their budgeted value in the last quarter, in which the ACC value is very low, that is 115.71% in negative value. The sales variance, everything is positive, and the JK Cements has got around 32.1%, 1.41% in the last quarter. But at the same time, the ACC has got very little, so 6.36% above the budgeted value. Anyhow, all competitors and the ACC have got positive values in the sales variance. That means they have reached the budget and more. But at the same time, the ACC has got a little more on the budgeted value. The next one is the ROCE percentage, that is return on capital employment. ACC has got 19.2%, really very good. However, the Ambuja Cement has got 22.14%. So this is the values, or we can analyze with its competitors. Hereafter, what we are going to do is we are going to analyze its competitor. That is okay, but those are all coming under the large cap and the Nifty large cap 100. So those are all also listed in the Nifty large cap 100. Only those shares are compared with the ACC. In peer competition analysis, here the first comparison is on market capital, the second is on PE ratio. third one is ROE, and the fourth one is a book value. The market capital, ACC has got very low market capital, we know very well, and it hasn't gone for any public offer recently. At the same time, the Ultratech has got really a good market capital among the competitors. B ratio is an important ratio. We know that it is a price per earnings, by which we can understand whether the share is undervalued or overvalued. This is one of the important ratios the analysts and the investors are using to find out whether the stock is undervalued or overvalued. Here the ACC has got PE as 52.9, around 53. However, the Ultratech Cement has got 29.5 as the PE ratio, so it may be cheap among all these competitors. That is what we can infer from this chart. The ROE by competitors, that is return on equity, ACC has got 0.14%, Ultratech 0.15%. Both are really good. So the management of these two companies are doing well to convert the assets and to convert the equity into profit. So the return on profit, the return on equity for these both companies are really good. The book value. What is the book value? The book value is the amount remained after subtracting the total liability from total asset. Actually, what the people are saying that when the company is going to bankruptcy, what is the shareholders get the money? That is called book value. And when we have to compare the book value with its market price. So in any one of our next videos, we can compare the book value with the market price value. Then we can identify which is the best one. So the book value is an important criteria by considering for buying the share. It can be compared with the market price. The next one is we are going to see the balance sheet parameters. The first one is the reserve, second one is borrowing, the third one is other liability, fourth fixed assets, CWIP, investment, other assets, and total assets or total liability. We know that reserve is for the future obligations, for building getting the new building, or paying any advanced taxes, or buying new equipment. Likewise, the ACC has got 9.85% for the last 2 years or 3 years. This is the average growth. Comparing with this, the Sri Cements and Ultratech Cements have got the average growth as great values. However, we need to find out the individual values, then only we can come to with some conclusion. So this can be analyzed with the detail and the comparison of all these cements, all these companies also. The next one is borrowing. The Ultratech has got negative values. That means they may be paying back their debts in the previous years. In the last recent years, they may be paying back their loans, by which they can reduce their borrowing. We have to get that is why we have to analyze individually also to find out how much borrowing they have got and how much they are paying back. All those things when we are doing the analysis on Ultratech Cements separately, individually. Likewise, this Sri Cement also has got some negative value. That means they are also paying back some borrowings or loans. ACC and Ambuja have got positive values. That means they are getting some additional borrowings for the last years. This is the growth for the last years, recent years. So they have got additional borrowings. The other liabilities, if the liabilities can be insignificant, or it doesn't have a single line in the balance sheet, then those liabilities are put together, and this is called other liabilities. The other liabilities we can also distinguish between other current liabilities, other long-term liabilities. If we have more data, then we can do that kind of analysis also. In other liabilities also, Ultratech Cement has got negative value, negative growth. That means they are reducing their other liabilities for the recent years. However, ACC has got 5.3 as the growth rate. They are getting more other liabilities for these recent years. These are, but the Sri Cement is getting more other liabilities in recent years, nearly 10%. The next one is the fixed assets. ACC has got negative values. That means they are lowering their fixed asset values recent years. This is per year. So they are lowering their fixed assets. The fixed assets may be buildings, machineries, and all other immovable assets. So the fixed assets wise, the ACC is losing its value for the recent years. The Sri Cement has got really a good value in the fixed assets growth. So they are increasing their fixed asset values. The CWIP, that is the capital working in progress. This is the amount that they have already been paid, but the work is in the progress. So ACC has got really a good growth in this area. It is 28.45%. That means they have already paid for some kind of progressing work that can be utilized in the future. The next one is the investment. The investment on other companies. It may be by stock, a bond, or any real estate holding. Likewise, they are investing with other other companies. The investing on other companies, Sri Cement has got really a good growth recent years. It is 31.72% of the existing there one. This is per year. So Sri Cement has got a really good growth in this area, investing in the other companies. The next one is other assets. I mean, the asset is not significant enough to list down in the balance sheet, then they will be put together and that is denoted as other assets. In this case, ACC has got a growth of 13.606 other assets, a good sign. They are improving their assets and the other assets also. So, and this is the case in case of ACC. Sri Cement had only 2.35% growth per year. Then the average total assets or average total liabilities growth. The average assets and the average liabilities are balanced, so they are equal in the balance sheet. And this any one of this value denotes the growth of the company. It seems that Sri Cement has got really good growth and ACC is following. Then we will move to the income statement. The various parameters of the income statements. The first one is revenue, second one is the total income, third one is the net profit growth, fourth expense, fifth total expense, and sixth the EPS growth. The revenue growth, total income growth, and the net profit growth are looking similar, and the in this the Ultra Cement has got really a good growth in revenue. I mean the cumulative total income and the net profit is also very good for Ultratech Cement. ACC is the revenue is very low and so that reflects in the total income also, total income growth also. So what in the and the average net profit growth is also in the range of 8.96. Expenses they are controlling. Ultratech has got 5.47% per year for the expenses. At the same time, the ACC has got minus 0.92% per year. It is well controlled. At the same time, the expenses should be compared with the revenue. So when we compare the expenses with the revenue, the competitors also doing good in controlling the expenses, because when the growth is 7.46% and the revenue growth is 7.46%, the expense growth is only 5.47%. So the Ultratech Cement management is also controlling expenses somewhat well. The next one is the total expense. It is also a reflection of the expenses, but with different percentages. And the EPS is looking like the net profit. Ultratech has got EPS great value, earnings per share. It is 25.45%. The ACC has got 8.97% per year. Next, we will move to the cash flow. The first one is the average cash flow from operations. Next one is average net cash flow. The third one is average cash flow from investments, and the fourth one is average cash flow from financial activities. The operation growth, I mean the net cash flow from operations, it is very important. This covers how much money the company is getting from the customers, how much they are paying to the suppliers, how much they are paying as tax to the government, how much they are paying as workers, direct workers salary. All those are covered in the operation, I mean the cash flow from operation. This is very important for the company to carry out their operations in a well manner. In this case, the ACC has got really a good growth of the cash flow from operations for this recent years. It is 23.51%. At the same time, the Sri Cement has got in the negative growth for the recent years. It is 1.73% per year. It is reduced in the recent years. The next one is the net cash flow. It is consolidated cash flow after considering cash flow from operations, cash flow from investment, and cash flow from financial growth. The ACC has got at 23.89% per year. At the same time, Ambuja Cements has got 292.58% per year. A great cash flow, net cash flow they are keeping. The next one is the cash flow from investment growth. It is investing themselves. They can do the investment like constructing new buildings, maintaining their equipment, buying their new equipments, some other plants, acquiring some other plants likewise. So in this, it is cash flow from investment growth. If it is in the ratio, one of the things we have to consider in constructing ratio is if the both values are negative, then it will become positive. So it is when we are comparing the ratios, it is always better to have the actual values with us, so that we can have a good idea about how the growth is representing. So in investment, the Ultratech Cement says 224.28%. If last year and this year both are in the positive, then this percentage is very good. If both are in negative, then we have to consider the more details how it is for in investment. This is the same case for financial growth also. So sometimes the company needs financial injection from outside to do their operations if cash flow from operation is not enough, or this is also covered. The payment to the dividend also covered in the cash flow for financial growth. So when we are comparing the ratios, it is always consider the values, the real values, whether they are negative or positive. Then only we can come to some conclusion. So we can have those details in the detailed application. So when we have that application side by side, we can analyze how good it is. Then we can go to the quarter income statement. It is like income statement, but it is for the last 12 quarters. So in this we understand that the revenue is reduced by 0.19% per year for ACC. At the same time, it is increased 1.52% per quarter for Ultratech Cement. This kind of representation is same for the total income also. The net growth wise, ACC has got some kind of positive growth with the values. However, the Ultratech Cement has got a negative values. They are reducing their net profit for the recent years, and the growth is in the decreasing trend. So every ratio we should have the actual value side by side to understand how important the ratio would be. The next one is the expense growth. This is also like the revenue growth, however in different numbers. So when we compare these two, how these companies are controlling the expenses against the revenue, that kind of information we can get by analyzing the revenue and the expenses side by side. Not only with the ratios, we should have the actual values, that means the actual values in the detailed application, so that we can compare these two, and how the expenses are controlled by a different competitor, we can come to some conclusions. So the next one is the total expense growth and the EPS growth also. So everywhere we need to have the actual values, so that we can come to some clear conclusion how it is being done. I mean, the growth is really positive or the growth is really negative. If both values are positive and both values are positive or both values are negative, then we can get a ratio in positive range. One of the value is negative, then we will have the negative ratio. So it would be always better to have the actual values by side, so that we can do the analysis well. The next one is the ratios. The debtor days. In the debtor days, ACC growth is minus 11.36% per year. That is really good, and they are having a proper control. I mean, in collecting the money from the customers, the account payable from the account payable. When compared to this, the Sri Cement and Ambuja Cements have got a really more control, but we need to actual, because we know that in the debtor days for ACC is 11 days, the actual debtor days for ACC is 11 days. However, we don't know what is the actual debtor days for Sri Cement. Then only we can have some idea about how they are controlling these days. This is common for the inventory days also. Inventory days control, we know ACC control on inventory days is not good when we are dealing with a detailed application. We understand that here the growth is 0.78% it says, but however the controlling of inventory days is very important. It will reflect in the CCC, that is cash conversion cycle also. The average days payable is also in the growth. Here when the ratio on the average growth is shown, the Ultratech Cement has got 14.97 days and ACC has got 6.39% growth. How much they are increasing their days payable with the consent of the supplier is very important. So in any one of our other applications, we can compare all these values with the actual value instead of the ratio. Then we can come with a clear understanding of how these companies are performing in this area. So in any one of other videos, we can come with the actual value instead of the ratio. This is applied for the cash conversion cycle as well as working capital days also. Then we will move to the shareholder pattern. Shareholder pattern, the promoter shareholding, ACC has got growth of 0.35% for these 3 years. However, the Ambuja Cements and Ultratech Cements, they have got a negative shareholding for the promoters. That means they are selling a very less percentage of their shares into the market. At the same time, ACC have got shares from the market. There is no difference in the Sri Cement. And the next one is FIS growth. The FIS share growth, ACC has got a positive value for the last 3 years. It is 1.06% per year. So the FIS investment in ACC has been increased for the last 3 years. At the same time, for the other competitors, it is reduced for the last 3 years because the growth is in the negative values. And the next one is in the average DA share growth. Here ACC has got negative value, so its growth is in the negative form. At the same time, all the remaining competitors have got more investment from the DAS. The average government share growth, there is no additional share bought by government in Sri Cement for the last 3 years, but at the same time Ambuja Cement and the ACC Cement, they have got some shares the government have bought some shares for Ambuja Cement and ACC. At the same time, government has sold some shares of Ultratech cement in the market because it is in the negative minus 4.32%. Then the average public share growth. Public share Ambuja Cement has got 2.62% per year this one. At the same time, ACC has got minus 2.55% per year. That means the public has sold their shares in the market for the last 3 years. The next one is the average other shares growth. For the Ultratech Cement has increased the other shareholding by 5.17% per year, and there is no change for the remaining companies for the other shares holding. Thank you with me for in this video. So this is one of the important analysis. When we are doing the fundamental analysis, we need to compare the stock with its competitors, then only we can come to some conclusions. In this video, we can compare with most of the things in the ratio values. When I have the time, then we can compare these values with the actual values instead of the ratio in any one of our new videos. Thank you again for your patience to watch this video.